One particular question coming in right now is the move up in the dollar a confirmation of risk aversion more broadly or a liquidity strain? Let's get to Steve Englander, shall we? Standard Chartered Head of Global FX Research, and ask him that. So, Steve, I'll repeat that question to you. The move in the dollar that we've seen, confirmation of risk aversion and or liquidity strain?
Look, it's both. I say that initially, say we went back to the early stages of this when the dollar was rising, and there was what you would call an orderly asset market fall. It was risk aversion. I think at this stage, it's the liquidity stage that's driving the risk aversion. So it's actually the two are actually the same. That market participants are looking at the demand for dollar assets and saying, and basically that's leading them to sell whatever they can, whatever is still liquid in order to get those dollar assets. So I wouldn't make too much of a distinction. I would say that if we solve the liquidity problem, some of this risk-off problem would be solved. It wouldn't be all of it because there's still an economic dimension in the background, but the money market dimension would be much easier.
So, Steve, let me ask you something that I think is incredibly difficult to do, perhaps even impossible. But let's pick a currency pair. Let's take cable, the pound against the US dollar. Over the last 4 years, since the Brexit vote, a break of 120, there's been support there. And quite clearly, there are no levels of support at the moment in an environment like the one we're in. We took out, I think it was 118.40 there and thereabouts, which was the flash crash low of October 2016. Knife through butter, 118, 17, 16, 15. 114 handle. Steve, 2 Mondays ago, we had a 132 handle. Let's say that these central banks can address this liquidity issue. You get back to fundamentals, and I'm trying to understand how much of this move lower in something like, say, cable was fundamentals, and how much was it just a freezing up of liquidity and a massive hunger for the US dollar? And if we address one issue, where does that currency pair go back to?
I think that in risk-off episodes, currencies tend to move more quickly to the downside and they recover when the risk-off is gone. But I think that sterling would recover a large part of what it lost. There's still some issues with respect to the Brexit deal, but those are very secondary. If you look at the last 7 or 8 big figures, I'd say it's all market risk perception. I think there is an issue there that you alluded to that's really important. That one of the question marks is how each country is able to deal with the economic consequences of the virus. In the sense that we know that there's going to be a big hit. Most people, or many people, are working from home. Normal activity is greatly reduced. The question is, which country is most effective in preventing a short-term hit from becoming a longer-term hit? And I think that once the money market issue is solved, that's going to be the question that investors are asking.
Well, let's ask that question right now, Steve. Which one?
Honestly, I don't know. I mean, you're seeing, what we have is the example of Asia, where it seems that the sort of draconian methods in some cases worked very well. The problem for Europe and the United States is we're still on the exponential spreading curve, part of the disease curve. So we have to wait and see, how much public adherence there are to the measures and how much they succeed. But we're probably at least a week or 2 weeks away from having any sort of sense of how effective these measures are.